Stocks have staged another impressive and vertical rally. Therefore, it's prudent to ask, how meaningful is the improvement on stock charts? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Regular viewers and clients may remember that back on February 12th, which is the day after the recent low, we asked a very similar question: how meaningful was Friday's stock rally, referring to Friday, February 12th. And the question was posed in the context of our longer-term investment time frame. Therefore, after a strong rally off the low, a good way to see where we are, let's revisit the exact same charts. Obviously, they have to have shown some improvement mathematically. The question is how much improvement, and we'll address that question right now. We'll cover this basic concept once and then use it on numerous charts. Clients and regular viewers know that this is a full bore bearish look. The chart here, we have risk on versus risk off. This is a diversified basket of stocks, the S&P 500, relative to a diversified basket of bonds. And you can see during 2008, when we're near maximum fear, the ratio here is below both moving averages. Blue is below red, and the slopes of both are down. When confidence starts to return, eventually we flip over to a full bore bullish look where the ratio is above both moving averages. Blue is above red, and the slopes of both are up. Therefore, after a strong rally off the low, how do these weekly moving averages look today? The answer is better than what we had near the low here, where price was below and the slopes were down. Now we do have some improvement. Price is back above, and you can see the slopes are turning up. For these moving averages that the model uses, the only question it asks about these longer duration moving averages in this case, and it varies from pair to pair, is do we have a bullish moving average crossover? At this point, we do not. And probably what's more important here, notice on the weekly ratio, what's the last thing this chart did? It made a new weekly lower low. This low here is below the previous low. Have we made a new weekly higher high? No, in fact, we're not even close. The ratio would have to move all the way up and close above this level here to print a meaningful higher high. So mathematically, absolutely some improvement, and we'll put some context around how much later in the video, but still a relatively concerning look, especially from a price or trend perspective. And the ratio still favors, from a probability perspective, defensive assets over growth-oriented assets. This still looks like a downtrend. It doesn't mean we're still in a downtrend. That's to be determined. The way the model works, we don't assume what's going to happen next. We allocate based on the evidence we have in hand. Is it possible that this downtrend is broken? Absolutely, positively, yes, and that's why we have to keep an open mind. But right now, clearly, with the evidence that we have in hand, a lower low, and we have not made a higher high of any significance relative to our longer-term time frame. How about the credit markets? Now we're looking at junk. I don't believe they're going to default higher-yielding bonds relative to more conservative and lower yielding defensive treasuries. This is full bore risk off. This is a full bore bullish look here and a turn in 2009. As of Friday, March 18th at 2 p.m., the exact same weekly chart has shown some improvement here, but really it's not any different than this counter trend rally here that was fully retraced. Since there's no magic indicator, magic chart, magic risk on risk off ratio, or magic moving average, the CCM market model is highly diversified. These weekly moving averages have not shown much improvement relative to moving average crossovers. Have some of the faster moving average pairs shown some improvement? Yes, they have, and we'll put some context around that later. This is the Dow here, 1987. We have a full bore bearish look. 1998, after a sharp correction and some Fed intervention, we had a bottom and a full bore bullish look. The present day chart as of Friday, March 18th shows some improvement, but we don't have the bullish moving average crossover, and you can see here we get the crossover. This is an example of there is no perfect indicator or moving average crossover. Many of them are helpful. Also, the last thing the Dow did, new low. This low here is lower than this low here. This high here is lower than this high here, and we have yet to make a higher high above this level. That might happen. It has not happened yet, and if I draw a trend line connecting these highs, it appears as if we are still in an existing downtrend. The math, the charts, and the model, they don't care about the fundamental issues of the day. 2002 weekly risk-off look in the NASDAQ when things started to really improve in the spring of 2003. We flip over to a full bore bullish look. One thing we know with mathematical certainty, if the NASDAQ in 2016 is going to go on and rally for months and years, mathematically, eventually we will get a bullish moving average crossover. Mathematically, it's impossible to avoid the bullish moving average crossover. We don't have it yet. We have a lower low on a closing basis, and we have not made anything that's even approximately close to an important weekly higher high on our time frame. This is a higher high here, but it's really not any different than this higher high here that occurred during a counter trend rally within the context of an ongoing downtrend. What happens next is to be determined. Looking at it a little bit different way, this chart here tells us the probability of being short in 2008 is better relative to the probability of being long. And then in the spring of 2009, this weekly chart and the bullish moving average crossover tells us we can see this before good things happen, that the probability of being long stocks has now flipped over relative to being short. It doesn't tell us what's going to happen next. It just tells us the odds are more favorable here than they were here. Similar concepts as of Friday, March 18th. Lower weekly low. We have not printed a weekly higher high yet. That's to be determined. We're very, very close to getting a bullish moving average crossover here mathematically, but we did not have it yet as of 3:08 p.m. Another risk-on, risk-off ratio. I'm confident enough to take a cruise, consumer discretionary stocks, relative to I better save my money and buy some peanut butter consumer staples. Risk on relative to risk off. Full bore bearish look here in 2008. Flips back to a full bore bullish look in early 2009. How does the exact same chart look today? If we look at this chart in terms of the S&P 500, remember the S&P rallies here and then we fall just like this ratio. We're not even remotely close to recapturing the loss on this ratio. Over the past 5 weeks, we haven't even recaptured half of the loss here, which speaks to the confidence in the current rally. This may change, but it hasn't yet. Market fractals tell us that we can transport the same concepts to a daily chart. Fastest moving average is blue. You can see here in 2007, blue is on top and eventually it's on the bottom. You can see during a counter trend rally here within the context of an existing and ongoing downtrend, we get mathematical improvement with the moving average turning up, and then the primary trend resumes. How does the exact same chart look today? On March 18th, similar to this period here during a counter trend rally, we do have some mathematical improvement, and also similar to this downtrend here, for the most part during the downtrend, it's not perfect. Blue remains below the other slower moving averages. We have rallied for 5 weeks, but blue is still significantly below these moving averages here. If you're a bull, you would prefer this chart to morph back into a look like this. Nothing is immune to a whipsaw, and here's a good example. If we add noisy and stressful price back to the 2007 chart, you can see we get several bottoms along the way and several counter trend rallies. The common theme between all of them is every single one of these counter trend rallies was fully retraced. That doesn't mean that's what's going to happen in 2016. We're simply referring to the probabilities and the facts that we have in hand now. Same weekly concepts. Now we're looking at risk on, risk off S&P 500 relative to a diversified ETF of defensive bonds, TLT, risk off look, risk on look. You would think that after a risk on week that the S&P 500 would have trounced defensive treasuries this week. Not the case. As of 1:54 p.m. on Friday, March 18th, defensive treasuries and boring treasury bonds were outperforming the S&P 500 by 0.28%. You can see we do have discernible mathematical improvement, but we don't have a bullish moving average crossover. Notice, we can get discernible mathematical improvement within the context of an ongoing downtrend. The last thing that this weekly chart did was clearly make a new lower low. We're not even remotely close to retracing these losses here and making an important higher high. That may happen, but we don't anticipate that. We're looking at the facts that we have in hand as of the close on Friday, March 18th, in terms of how we score the model and allocate our assets. A simple question would be, does the present day here look more like this period here or this period here? As we've discussed many times, mathematically it's very difficult to forecast what's going to happen. It's relatively easy to get a handle on what is happening, what's in front of us. This remains extremely important. Successful traders focus on what they are doing with an unconditional belief. Everything outside of that is just noise. Noise doesn't mean those things aren't relevant. They're not relevant to our decision-making process, and all of that noise, the Fed, valuations, earnings, all of that is captured by the markets and interpreted by the markets, and the model monitors the markets. Therefore, the noise is accounted for in the model and in the charts. The key takeaway here is continue to execute consistently. Another set of weekly moving averages. The model looks at the weight of the evidence. Notice here, during early 2007, when the stock market is rising, the fastest moving average is on top, and the slopes of all of the moving averages are up. Contrast that with early 2008, when the fastest moving average is on the bottom, and the slopes of all of the moving averages are down. The present day chart allows us to see some incremental improvement and some things that have not improved yet. Here is some of our discernible improvement with the slopes turning back up, but we don't have any bullish moving average crossovers. At 1:53 p.m., blue was still fractionally below red here. This is an example. Remember we said if the S&P 500 moved over 2060 that the math would start to improve at a faster rate? Well, this is one of those charts. If we continue to move higher, eventually we will get bullish moving average crossovers, but it hasn't happened yet. Let's just look at this chart from a trend perspective. We broke a trend line, step one for a trend change. We made a lower high relative to this high, which is step two, and then we made a discernible lower low, which is step three, confirming this trend change from a probability perspective. Probability means that the lower probability outcome, a higher high, can occur out of any profile. Right now, this chart still looks like a counter trend rally within the context of an ongoing downtrend. Similar concepts, blue on top early in 2007, blue on the bottom. Notice here, within the context of an ongoing downtrend, there's a counter trend rally, and we start to see mathematical improvement. To give us another reference point, these are the same moving averages here as of April 10th, 2015. Market continues to have a strong trend. Fast forward to the present day on March 18th, and this confident look has morphed into a downtrend with a series of lower highs and lower lows. Here's a January 20th post from Short Takes, and the purpose of this was to help us psychologically prepare for what we knew eventually was coming, which is a counter trend rally. As humans, when we see bearish charts, we tend to expect the market to drop every day. Since we know markets do not work that way, it is prudent to remind ourselves that any sharp drop, a correction, or a bear market is typically accompanied by sharp counter trend moves. That post appeared here during the sharp downtrend. This is the low on February 11th, 2016. So let's put some context around how much improvement in the hard data and answer some logical questions about our allocations and what we have done and what we have not done over the past 5 weeks. One of the reasons why we haven't had to make many adjustments, and we've made one significant adjustment to the growth side, and it's not even a significant adjustment. We added to a position that we already had during the past 5 weeks, but it was a hybrid position. One of the reasons why we've been able to be patient is the trends were so incredibly weak at the low that even though the market has rallied strongly, it has not really corrected a lot of the damage that was done, and we've shown that on some of the charts that we've covered. In general terms, near the low, the model was registering a 0 for the most part. Every single question we asked was coming back bearish, or we couldn't clear a mathematical hurdle that the model asked questions about. Obviously, after a 5-week rally, something had to improve within the model and mathematically. Did it? The answer is yes, and we've shown some of the improvement in this video. So in general terms, the model has moved from everything being bearish to about 75% of the data or the questions being asked by the model in general terms are now bearish. So the weight of the evidence has improved, but the net outcome is still heavily favored toward the bearish end of the spectrum. A fair question might be, if we went from 0 to 25, how is it possible that we have not had to reallocate our portfolios more significantly? Because we really haven't made any significant changes over this period. As I mentioned, we added to a position that we already had down here when we were at 0 roughly. The answer to that, we know that counter trend rallies form, and we also know what assets have a tendency to do well in downtrends. Therefore, during this period here, we build a portfolio that acknowledges that an inevitable sharp counter-trend rally will come. And if we look at our present allocations, we already hold enough growth-oriented or hybrid assets to remain within the context of the rules and the hard evidence. If the market improves much from here over the next 5 trading sessions next week, that probably won't be true, and we will have to start to change our allocations a little bit. But we haven't had to do it yet. After a 5-week rally, it's prudent to remind ourselves that since 1930, 45% of the trading days in bear markets have been green days, which tells us it is quite normal to have counter-trend moves within the context of a bear market. Are we currently in a bear market? We don't know that. We don't need to know that. What we do know is the facts that we have in hand, and we know the trends that are in front of us now. Whether or not we're in a bear market is irrelevant to our allocations. And remember, we know these are the top 40 trading days in terms of green sessions for the S&P 500 within the context of this downtrend. Therefore, a counter-trend move, a strong counter-trend move, should come as no surprise from a historical perspective. You may argue that the financial crisis was a unique situation. The stats are very, very similar in terms of the top 40 trading days within the context of this downtrend. You can see there are numerous strong and sustained counter-trend rallies. They have something in common. All of them were fully retraced. Context matters, so when defensive-oriented ETFs are doing well, that tells us something about the market's current risk tolerance. You may remember back on January 8th, we said the Japanese yen was one of the few ETFs that did well during the financial crisis. Has it done well year to date in 2009? The answer is yes. The conservative ETF has gained 5.4% since we covered it on January 8th. Earlier in 2016, we covered the 3 legs of the stool story, and part of that was it was possible that the markets were getting closer to having a perception that central banks were losing control. Should be noted, the lead story on the front page of the Wall Street Journal on Friday, March 18th. You can also find it on WSJ.com. Was global currency soar define central bankers. It's the same concept covered in the 3 legs of the stool story. Here are 2 important quotes that appear early in the article. Efforts by many of the world's central banks to weaken their currencies are failing, raising concerns about whether policymakers are losing the ability to wield control over the financial markets. These difficulties are a reminder that the long stretch of exceptionally low rates in response to the 2008 financial crisis has created market distortions that may be difficult for central bankers to contain. That perception may be one of the reasons why defensive-oriented and hybrid assets have held up relatively well during the past 5 weeks. Does this concept or this story require us to make changes to our approach? No, all of this is captured in the charts of the markets as well as the charts of the ETFs. One thing that we have noticed is that weaker dollar ETFs are starting to move up in the rankings, and we noted that with this tweet on Thursday evening. And then on Friday, this story started to hit websites. Did central bankers make a secret deal to drive markets? Whether or not that's true is irrelevant. it is also captured in the charts. However, if the dollar continues to weaken, that is something that we need to respect, and it could push oil and stocks and weak dollar-friendly ETFs higher. Another possible reason for the defensive and hybrid ETFs holding up better than expected is the market's perception that it's getting harder and harder for the world's major central banks to pull the right levers to keep everything under control, from oil prices to stock prices, currencies, and economies. Part of the hypothesis around the central bankers getting together to depreciate the dollar was to stem the decline in oil prices. Whether or not that is true, again, is irrelevant. But it should be noted, here's the decline here on January 21st, and the same chart as of the close on Thursday, March 17th. Note that this trend line was drawn weeks ago, and when the dollar started to depreciate, it did help oil prices, and we've moved above that trend line. All of this just helps us in terms of keeping an open mind about all outcomes. A weaker dollar here would be a new development, and it is something that the charts and the model will respect. This brief little exercise here puts some additional context around the concept of central banks potentially losing control, and it also puts the current rally in some context. A very, very sharp rally here was eventually fully retraced later on, and look at the slope of this decline here and the slope of this ascent. And then in the summer of 2015, we get a vertical, almost straight up rally in the stock market. These are unusual slopes, and the slope of this rally might have us thinking that everything is great and we're going to go on to make new highs. What happened next? Instead of going on to make a higher high, we made a discernible lower high, and then this wonderful rally here, 100% of it was retraced and given back. And that retracement was followed by, you guessed it, another odd and vertical straight up rally off of the 2016 lows, reminding us that while the current rally is unquestionably impressive, a very, very strong rally really doesn't guarantee us anything, because just as quickly as stocks can go up, they can go down. Just as quickly as they can rise, they can fall. What happens next is absolutely to be determined. Here, what's the last thing that the S&P 500 did? It made a new lower low. Has it made an important higher high yet? The answer is still no on our time frame. Also note the health of the market's technical profile here during this rally. And we did go on to make a higher high after that. Here during this rally, the market's technical profile is discernibly worse. And it's even worse now. So we could make the argument that this rally is identical to this rally. Well, that's not true if we look at the longer time frames. As we've gone nowhere here, and apparently nothing has happened, in the background, the long-term momentum is being lost and the trends are rolling over. All of this may change. We would like to see a high here, and even better, a high above this trend line here and above this level here. That absolutely, positively may happen, but right now, this still looks like a counter trend rally within the context of an ongoing downtrend. You may say, well, the 50-day is starting to turn back up. The 50-day turned up here, and this strong rally was fully retraced. It's relevant, but it doesn't mean that the downtrend is over. A few cases in point. Primary trend down in the dot-com bust, 50-day turns up, 50-day turns up, flattens out, turns up. It does turn up here, but also notice that the 200-day and all the other data improved along with it. That absolutely may happen in the present day, and if it does, the hard data, the math, and the model won't miss it. In terms of the probabilities of the S&P 500 going on to make new highs, I think this is a relevant point. When the market was here, it was very, very difficult within the context of the model and especially the ETF scoring system to find anything around the globe or in any asset class that was beating the S&P 500. The list was very, very short, and it was very U.S. stock centric, meaning it is possible that even under a hypothetical bear market scenario, the previous leader, if there is any asset class or any market that would be able to push to a surprising new high, it would be the S&P 500 and the U.S. markets. They were so strong and such a leader here, even under the context of bad things happening, it wouldn't be a shock to see us get up into this area here. Like many other things, if that happens, we don't have to change anything that we're doing. The math and the model will help us discern how important that move is, and we will make the necessary adjustments along the way. It never hurts to be psychologically prepared for the lower probability outcomes. That way, we can maintain that maximum and much needed flexibility. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.